Today, the peace talks in Vienna have just sliced through Brent crude like a hot knife. Price is down hard, stocks are ripping higher, and every retail trader is asking the same question: is the oil bull market dead? But while the crowd panics, there is one danger zone and one hidden opportunity that the algorithms haven't fully priced in yet. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels that turn this volatility into a plan, not a prayer. Right now, Brent crude is trading at $104.92. The short-term charts are screaming strong sell. 1-hour trend strong sell. 5-hour trend strong sell. But here is the trap. The monthly chart is a freight train, strong buy. The weekly chart, strong buy. The daily is neutral, sitting exactly on the edge of a cliff. That kind of contradiction is where fortunes are made and lost in a single session. Write this number down right now. $101.67. That is the daily support. If Brent closes below that number on the daily time frame, the entire structure shifts and the bulls lose control. We are not even 120 ticks above it. This is the line in the sand. Let me pull the lens back and walk you through the architecture of this market, because if you only watch the 1-hour panic, you will get washed out. On the weekly time frame, Brent crude has been carving a textbook bullish staircase since the December lows. The 50-week moving average, currently sitting around $93, has been a perfect launch pad for 3 consecutive legs higher. The 100-week moving average is even lower, near $82, and we are nowhere near it. This is a deeply entrenched bull trend. The last weekly close we had was above the 10-week average, and the MACD on the weekly is above the zero line, although the histogram bars are shrinking, a warning that momentum is losing steam but not yet reversing. Now drop to the daily. This is where the pain becomes visible. Price has just sliced below the 5-day moving average at $106.91, the 10-day at $107.59, and critically, the 20-day moving average at $106.47. Brent is below all 3 short-term daily averages for the first time in 2 months. The RSI on the daily has dropped to 49.86, smack on neutral, giving no edge. The MACD line is still positive at 1.055, but we are seeing a bearish crossover signal forming. More importantly, on the 4-hour chart, there is a glaring negative divergence. While price made a marginal new high 3 days ago near the resistance zone of 109.92, the MACD on 4 hours was making lower highs. Buyers were exhausted. This pullback was pre-programmed in the momentum structure, and now it is playing out. Now let's map the actual support and resistance numbers you must have burned into your screen. On the upside, the immediate resistance is the old breakdown point, the 20-day moving average at 106.47. A move back above that recovers the daily neutral bias. Above that, the real gatekeeper is the range high at $109.92. That level aligns with the top of a 5-week consolidation channel. A clean break and close above 109.92 opens a run to 114.83, which is the next structural liquidity pocket from last year's highs. On the downside, the first support is the one I told you to write down, 101.67. That is the May swing low and the bottom of the weekly value area. If that goes, the market will quickly probe 98.33, which is the March consolidation floor and the 100-day moving average zone. Below that, the 200-day moving average sits way down at 82.39, and while that feels distant now, remember, momentum can accelerate fast in commodity markets when risk premia collapse. The key takeaway from the technicals: we are in a secular bull market experiencing a sharp, news-driven correction. The daily moving averages are rolling over short-term, but the long-term structure, weekly and monthly, remains upward. That is the classic setup for a pullback buying opportunity, but only if the support holds. Now let's connect this to what actually happened in the last 24 hours, because the fundamental driver of this drop is not a demand shock. It is a pure geopolitical premium unwind. The headlines hit late in the European session. Oil falls, stocks climb as investors hope for progress in Iran war talks. That is the narrative. Markets are pricing a potential path toward de-escalation, which would eventually bring some Iranian barrels back into the global supply calculation. The immediate reaction is a relief valve opening. The war premium that had been bid into crude since the hostilities erupted is being rapidly repriced. When stocks rip higher on the same news, we know this is a risk on rotation, not a global recession fear. That is important, because recession fears send oil down with demand destruction concerns. This is a supply-side story. And here is where the cross-asset linkage with gold becomes vital. If this were a pure liquidation event driven by margin calls or a macro meltdown, gold would be getting hammered alongside oil. But look at gold today. It is holding firm, even edging higher. Real yields are not spiking, they are stable. Gold is keeping its geopolitical bid even as oil loses its war premium. This tells me the inflation and safe haven pulse is still beating under the surface. The oil sell-off is a targeted attack on the supply shock narrative, not a broad commodity exodus. That divergence between gold and oil is my first signal that this dip is a correction, not a regime change. The second signal comes from the equity side. The S&P 500 is rallying, driven by lower energy input cost expectations and improved sentiment. This is a classic peace dividend move. And while I'll cover the full S&P and Bitcoin divergence in the next video, just know that risk assets are not confirming a systemic breakdown. They are celebrating. That puts a floor under how far oil can realistically fall in a growth-positive environment. Now the million-dollar question: what do traders expect beyond the headline noise? The latest institutional survey shows traders expect oil prices to remain above $81 for the next 12 months. That is a critical anchor. It means the smart money is not betting on a collapse to $60 or $70. They see the long-term equilibrium price structurally higher. With the 50-day moving average already at $100.12 and the 100-day at $91.48, a dip into the 101 to 98 zone would simply be a reversion to the mean in a bull trend, not a breakdown. So my 1 to 2 week directional lean is this: the short-term momentum is down, and we could easily wash into the support zone. But the path of maximum probability over the next 2 weeks is that Brent stabilizes in the 101 to 106 range and then sets up the next leg higher. The exact event that would invalidate this thesis is a daily close below 98.33. That would break the higher-low sequence on the weekly chart and open the trapdoor to 90 and then 82. Until then, I am treating this as a buying opportunity within a bull market. Most people will skip this next section, but this is where money is made. Keep watching, because I'm about to give you 3 specific trade strategies, with exact price triggers, stops, and profit targets. These are designed for the volatility we are seeing right now. Do not just watch, pull out your platform and mark these levels. Strategy 1. I call this the sniper, conservative approach. This is for traders who want to buy the dip only when the market proves it can hold. The trigger condition: Brent crude must print a 4-hour candle close above 102.20, and simultaneously, the 1-hour RSI must climb back above 45. That combination, price clearing near-term resistance with improving momentum, tells us the selling is exhausted. Entry is on a retest of the 101.67 to 102.20 zone. Stop loss goes at $100.80, just below the psychological 101 handle and the Monday low. That gives you a tight, defined risk. Target 1 is 105.80, just below the 5-day moving average, offering a risk-reward ratio of roughly 1 to 2.5. Target 2 is 108.20, which lines up with the 20-day moving average and the midpoint of the recent range. If we hit target 1, move your stop to break even. This setup is voided if price breaks and closes below 101.50 before any entry. That would signal the support is failing and we stand aside. Strategy 2, the active trader, standard approach. This one is for those who want to fade the fear and catch the mean reversion. The entry condition: we need to see a sharp intra-hour spike down into the support zone of 101.67 to 99 flat, followed by an immediate rejection wick on the 15-minute chart, closing back above 101.67. That indicates a failed breakdown and a liquidity grab. Enter at market on the 15-minute close above 101.67. Stop loss sits at 98.10, below the 98.33 support, giving room for a fake-out flush but protecting against a true breakdown. Target 1 is 104.50, the pre-news consolidation area, for a quick risk-reward of about 1 to 1.5. Target 2 is 107.20, just under the 10-day moving average, where the trend begins to bend. Once target 1 is reached, trail your stop to the session low. This setup exploits the emotional overshoot that usually happens around geopolitical headlines. Let's see how aligned we are. Type your Brent crude range for tomorrow in the comments right now. I'm reading them, and I'll engage with the best calls. Strategy 3, the aggressor, high risk. This is only for those who know how to lose small and manage risk aggressively. If the peace talk momentum accelerates and price slices through 101.67 with conviction on the 1-hour chart, meaning a full candle close below that level accompanied by a volume spike, then you can short the retest of 101.67 from below. Entry on the first pullback that kisses that broken support as new resistance. Stop loss goes tight at 102.80, just above the breakout candle high. This is a counter-trend momentum chase within a larger bull trend, so precision is everything. Target 1 is 100 flat, a round number liquidity pool. Target 2 is 98.80, just above the 98.33 structural support. Risk-reward here is roughly 1 to 3, but the probability is lower because you are fighting the weekly trend. I must be explicit. If you take this trade, size it for a loss you can smile about. This is about capturing the last gasp of a news-driven flush, nothing more. Before you execute any of these, the risk management pulse. Never risk more than 1 to 2% of your account on a single trade. No positions through high-impact news events like the official Iran deal announcement or a surprise OPEC statement. Stops are non-negotiable. The market will be here tomorrow. Make sure you are too. Here is the one number that matters most for the next session, 101.67. That is the bull market spinal cord on Brent crude. Hold it, and we are buying the dip for a rally back into the 109s. And beyond. Lose it on a daily close, and the entire energy complex gets a deeper haircut, potentially dragging the risk-on trade into a liquidity vacuum. Tomorrow, all eyes will be on the follow-up headlines from the Vienna talks, and I will break down the moment we get a confirmed structure shift. I'll also be releasing the full Bitcoin and S&P 500 divergence video that is crucial because the equity pump from these peace talks might be the exact force that sends Bitcoin into its next leg. That video is live now. Check the end screen and keep your crosser set awareness razor sharp. If this analysis gave you a clear plan for Brent crude today, smash the like button so the algorithm knows this is actionable institutional content. Subscribe, hit the bell, and type 101.67 in the comments if you're watching that level with me. I read the comments every day. I'll see you in the next one, where we dissect whether the dollar index is about to confirm the oil move or blow it all up.